Welcome back to the channel, and in this video it's kind of a user focused video, and a lot of you have been asking, Jamie, you're doing these sort of economy updates, understanding is it going to go down, is it going to go up, and I'm really worried, should I invest in property right now, or should I wait until it calms down? Should I wait until the recession? Should I wait until it corrects until next year? And I thought, you know what, I've been answering them individually, and I thought, why not just create some content around my opinion of whether you should be investing in property right now, or even if it's for your residential, should you be buying right now? And that's what we're going to cover in this video. For those that don't know me and are new to the channel, my name is Jamie York. I've been investing in property for the better part of a decade right now. And I created this YouTube channel just to add as much value as possible and no BS property investment advice around my philosophies around investing, that hopefully it's going to add some value to you. Okay, so the market right now is insane. It's what we would call a seller's market. Now, this is a bit intense because what we're probably seeing in a lot of areas is 100 grand properties going for 120, £500,000 properties going for 560. And it's easy to think, oh my God, this is really powerful. And people go, oh my God, the last recession, this is what was happening. Everyone was talking and blah, 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 blah. So should I actually invest right now, or should I wait? So let's actually look, why is the market insane right now? Because in a lot of ways, it doesn't really make sense, does it? We've got the risk of furlough coming to the end and a load of people getting sacked. There's loads of businesses shutting down. Retail has been absolutely crippled. A lot of people have lost family members over this last year, and it's been really tough all round. So why would there be a buying frenzy? Well, this is because of the government's reaction. So there's been stamp duty relief for a lot of people, then that's been extended. There's been a lot of help with mortgage relief, so 5% mortgages, for example. There's been the extension of furlough, there've been B bills, there's been C bills, now there's the regeneration loans, there's local grants. And all of this, you might think, okay, well, why does that help? Because it's money getting pumped into the system. If we're making it easier for people to buy, what happens here? If you've got let's say a normal buyer, residential, needs a 10% deposit. And let's say they were thinking, you know what, I'm almost at 20 grand now. And once I hit 20 grand, I'm going to buy a £200,000 house. Great, amazing. That's what people's mindsets are. If you go, right, 5% deposit, hardly anyone goes, wow, I only need 10,000 now for my £200,000 house. That's great. It gives me some money for a little refurbishment, or maybe we can go on a holiday. They don't go like that. What a majority of people go is, hold on a second. I've got 15,000. I was going to save to 20,000, but now because of the 5% deposit, I can get a £300,000 house, right? And then they'll check with the bank to see if they've got lendability. Because naturally, it's human behavior to expose ourselves as much as we possibly can. Even though it's completely illogical from an investment sense, that's what we end up doing. So as long as it's affordable by what the banks say, we end up pushing that up. So suddenly, those £280,000 properties, they'll now pay $300,000 for it. Oh, by the way, you don't have to pay that additional stamp duty that we spoke about before. So give us an extra drink, right? And so it pushes it up. The other thing as well is it gives confidence in the market. Now in 2007, 2008, the reason why it started crippling is because of lack of liquidity. It was overexposure in mortgages, subprime mortgages, all of that sort of thing. A video for another time. And so it's completely different as a black swan event. For those that don't know, a black swan event is those, you can expect a black swan event every 10 to 15 years, but you don't know what it's going to be. This has been a black swan event. The crisis was a black swan event. The difference is liquidity in the market. There's actually a lot of money circulating around right now. So we're in a very strong financial situation. So, you know, will there be a correction from this? Probably. Will it be as drastic as that? No, almost definitely not. So because there's so much confidence in furlough, the stamp duty, the C bills, B bills, helping businesses along, it gives everyone a lot more confidence in the stability as a country as a whole. So even though, you know, it's kind of like, imagine going to a stick that's in the ground, you know, one of those bamboo sticks that you're growing a tree and tie to it, and you shake it like that. You know it's going to do some damage. You can probably break it. You can probably dig up the soil. But that's what's happened, that shake in the economy. The difference now is there's this big steel, what is it, an RSJ, just planted in the ground with cement around it. So I can punch it, shake it, try and do everything I can. It's unlikely to do that much damage. I mean, I am hard, but not that hard. No, oh my God, edit that out. No, but it's like, I'm not going to cause any meaningful damage to that steel, right? And that's what our country kind of is now in comparison. So should we end up investing right now, or should we wait? So first of all, will there be a correction? I think yes, there will be. I think there will likely be a correction, and I think we'll be seeing between a 5 and 10% correction. But the difference is, number one, when will that correction be? I'm sorry, my orb is gone. I cannot predict the future. I genuinely don't know. My guess would be we'll start to see the impact when furlough ends. And I think that will not just be an impact as in seeing it decline. I think we'll start seeing how businesses are reacting. So is it people are going to get to the end of furlough and then we're suddenly seeing unemployment shoot up? That's going to be quite a telltale sign. Are we going to see further enhancements, grants, loans and help from the government? We'll see. And we'll start to see the impact of that, and the story will become a lot clearer. So number one, I can't time it. I think it may be the start of next year that we'll start seeing some results and outcomes from that. Number two is how what that discount's going to be hit from. Is it 5 to 10% correction to what the market was before? Or is it 5 to 10% correction to what the market is now? I don't know. Okay, and I think that's really important when we come to our final conclusion for this is we don't know. It's predictions, it's guesstimations. We're trying to work it out and analyze the data as we're going along. So I think the first thing you need to be asking yourself is, when are you looking to exit the opportunity? So I think this really divides into short-term and long-term. Short-term, I'm going to count as the exit being in the next 2 years. And I think this, honestly, is the only time you should be really worrying about your exit and maybe just being a bit more conservative about it. So for example, if you're working out on today's figures and growth, making a £15,000 margin, and you're looking to do some sort of flip, I'd maybe increase that a little, not drastic, maybe 17 and a half, to allow for some small correction if it does happen in your exit in the next year to two. However, if you've got a long-term thinking, you would have heard me say in previous videos that my exit is death from a lot of these opportunities. I know it sounds so morose, but actually what I mean by that is I'm looking at the next 30, 40, 50 years, and I base my figures on return on capital employed. So what return am I getting today with my money left in the property as a worst case scenario? And I make my investments on that basis. So over the long term, I don't really care if the market goes down 5 or 10%. It doesn't matter. Now, if I only had money for one property, would my mindset be a bit different? Maybe, but I don't think so. And the reason why is I know on average properties are, they say doubling every 10 years. It's a bit longer than that in reality. But even if we said conservatively 5% growth, that's not 60%. Over 10 years, it's more because it's your compound effect, okay? So it's 70 to 80% growth over that period. Well, over the next 30 or 40 years, am I really going to give a shit about a 5 to 10% correction today? Almost definitely not. So for me, I have my investment criteria. It's the same criteria now as it was last year. It's the same criteria that I had 3 years ago, and I'm telling you, it will be the same criteria 5 years from now. So I just don't care. Now, I would if I were overexposed. So back in the last recession, people go, oh yeah, what about the mortgages getting called in? It's like, if you actually look at the trigger for that, mortgage companies don't want to pull in mortgages. It's incredibly rare for it to actually happen. The only people that I saw getting that done is people that were massively over leveraged. A majority of people, and I mean people where they've got a 100 grand mortgage on a property worth 75 grand at max, they didn't get their mortgages pulled in. And it's because they're just paying regularly because of the rentals. And that was when they were getting 100%, 110% mortgages. Right now in buy-to-let investments, it's usually 75% loan to value. So that's a lot of correction in the market for it to all go wrong. So as long as you're buying for the long term, which I'm making the assumption a lot of people watching this channel are, then you shouldn't be worried about those minor corrections. And the impact to you is actually minuscule. People go, yeah, but you'll be able to make your money go a lot further. Not really. Let's think about this logically. If I buy a property for £100,000, I need to put 75 grand I need to put in 25,000 deposit. Forget the everything else like the stamp duty and all of that, because you're going to have to pay legals, all of that anyway. Let's say the market, yeah, but Jamie, if you bought that in a year and it's dropped 10%, how amazing is that? Well, the 10%, £10,000 in this case, is nothing in the grand scheme of things over the next 30 or 40 years. It's not, it really is absolutely nothing. Especially when you consider the actual cash difference is only 25% of that. So it's £2,500. So I'm going to wait and risk all of that time. Let's say it's a year and it actually does drop 10%. Oh my God, amazing. Well, no. Yes, you've made your money go a little bit further, but what you've missed out on is the net £300 a month cash flow coming in for the last year. So you've missed out on £3,500 or £3,600 in that sort of situation. Why on earth would I risk that? Remember, if you try to time the market, you'll never get in the market. There is no best time. You know, there's that old Chinese proverb, the best time to plant a tree was 10 years ago, but the second best time is today. And I feel that way about property investment. The best time to invest is now. And I see people going, oh, never invest, it's going to collapse, it's going to do this, it's going to do that. And by the way, if you're one of those, you can leave a comment below it, so it's absolutely fine. But most of those people, they're my investors that back in Brexit, oh no, I'm going to wait for the Brexit vote. Then the Brexit vote coming, oh my God, it's going to collapse. I need to pull out of any investments. Then it was the bloody, well, we've had loads since then, the elections coming in. Then obviously the big C that we've had over the last year. Then it's the re-elections. Then it's furlough coming to an end. Furlough's been extended. I'm going to wait until then. They're the people that are continuously coming up with a reason not to invest. And actually, historically speaking, those that have been able to time the market haven't been that much better off over the long term. And I'm talking the 40, 50, 60 years of investing. And so actually what you want to look at is something called dollar cost averaging. Dollar cost averaging is something by Robert G. Allen. He wrote a book called Multiple Streams of Income many years ago. And he spoke about dollar cost averaging. In fact, you don't try to time the market, it's time in the market. So my honest opinion, and not financial advice, but advice in general around property investment, is don't wait to buy property and wait. And for me, and I'm following my criteria of return on capital employed, ROCE, and for me is buy, but stick to your criteria and don't become a motivated buyer. So let me know what you think. That's just my opinion, okay? And I've done pretty well over the last near decade, and I expect to do well over the decades to come. I'm not worried about a huge correction. I'm looking to buy right now, and I'm just focusing on that criteria to move forward with, knowing that even if it does dip a little, it's still somebody that's renting the property. I'm still getting my cash flow, and I'm still getting my passive income. But let me know what you think. Do you agree? Do you disagree? And it's okay to disagree. Let me know in the comments. I'd love to have a debate and chat with every single one of you, and I do my best to get back to as many as possible. And for those of you that got value from this, it would help tremendously if you just hit that like button. And if you're interested in some no BS property investment advice, then this is definitely the channel for you. If you're not already, it would help amazingly to help grow the channel if you just smash that subscribe button and the notification bell. And of course, I'll see you in the next video. And in the meantime, why don't you just give this one a watch?